You can see the massive accumulation by the central banks, who told us that they bought 16 tons of gold in the first quarter, the largest first quarter ever in the purchases by the central banks ever. So the central banks know that the U.S. is facing accelerating inflation, but every reduction in paper leverage means the physical market has more influence over time. And last piece is, don't be surprised if this recent pullback not only was the opportunity for the biggest buyers in the world to load up on cheaper prices, physical. You see these huge deliveries, while the weakness of paper holders get shook out. It's how the public gets shook out. But don't also be surprised if part of it was the levered paper positions in China are forced to unwind. But come Monday, the Chinese retail investor who still wants silver won't have margin accounts. They'll have a choice to buy ETF or a bar. And I have an idea which one I think they will choose.
Global financial markets are rapidly approaching a critical turning point as unprecedented paper leverage begins to unravel across international exchanges. Central banks, foreign governments, and sophisticated capital are quietly abandoning paper fiat currencies in favor of tangible commodities every month, signaling a widespread loss of global faith in the stability of the U.S. dollar. Andy Schectman, a prominent precious metals expert and financial analyst, emphasizes that sovereign central banks are secretly accumulating vastly more physical gold than official records indicate to insulate themselves against accelerating global inflation. Every reduction in paper leverage will cause physical supply constraints to exert far greater control over precious metal pricing over time. As paper gold trading accounts in major Eastern markets are phased out, retail investors will overwhelmingly choose physical bullion bars over paper substitutes, driving an enormous shift into tangible assets. Meanwhile, leveraged paper market holders face imminent shakeouts as speculative positions unwind, setting the stage for physical metals to dictate global market value. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
When you look at central banks and foreign governments and sophisticated capital quietly exchanging paper for hard assets every month, that should tell you all you need to know about where confidence is heading. And that's one of the central messages that I've talked about with you for a long time now, that price is a tool of misdirection, that you can see the lack of demand for the long end of the bond market. You can see the massive accumulation by the central banks, who told us that they bought 16 tons of gold in the first quarter, the largest first quarter ever in the purchases by the central banks ever. And the World Gold Council said, you're all lying. You bought 244 metric tons. You bought 15 times more than you're telling us. So the central banks know that the U.S. is facing accelerating inflation. At the same time, they are witnessing in real time a loss of global trust, and that the dollar is backed by nothing. And, you know, when I say loss of global trust, that's not hyperbole. Reuters talks about the worm turning, right? Says that only 11% of Europeans polled think the United States is an ally. I've been watching Tom Hanks' World War II series on the History Channel. It's incredible, by the way. If you're a history buff, watch it. It's like a 20-part series, and it's all real footage. It's very heavy. It's not for the faint of heart. We live in a world that is very fluid and dynamic all of a sudden, and that has been distorted on many levels, largely due to financial manipulation and suppression of free markets. The distortions and the second and third effects of these distortions are real. And as things start to like the carry trade, the carry trade, which was the world's piggy bank that allowed to borrow in yen at zero and then reinvest it in assets like U.S. treasuries or stocks or other things around the world, created an environment where people thought this would last forever, and it distorted asset prices. But it was an orderly accumulation of assets, an orderly for years, accumulation of these assets that created the leverage, which is synthetic, really, in terms of how it would be if there were no carry trade. But as the carry trade unwinds, one could argue that it will be anything but organized. It will be chaotic as everyone runs through the door at the same time, trying to not get trapped. And so, yeah, these are things that I promise you there isn't a lot of people in the U.S. looking at that, average mom and pop, but we do, and John Rubino does. And when you talk about how that could become very scary very fast, it's real, because as it would unwind and asset prices collapse again, the second and third effects of that happening have other issues, as we have record margin debt, and then the margin debt explodes, and then it's forced liquidation, which it's a domino effect. And I think maybe this is why Warren is sitting in cash, and maybe this is why we're seeing deliveries on COMEX continue to rise. Now, again, I want to say something, and that is that taking delivery means taking physical, not paper. It could be a house account where it stays in the house account at COMEX. They want the gold in the vault, not rolled over, not a paper settlement. And that should be the signal under the noise, that the big bullion banks, or those that are doing this, are choosing the physical metal over the cash settlement. And I think while delivery notices don't necessarily mean that ounces immediately leave the COMEX vault, some do, what people should focus on is that they do represent an intention to take delivery. And when we look at July, especially in silver, it's one of the most active delivery months I've ever seen. In gold, as of Friday, I believe we had seen roughly 12,400 contracts stand for delivery, just under, which would be 1.24 million ounces of gold. And just doing a little basic math, what's that? 1,240 times, call it 4,100. It's $5 billion worth of gold that stood for delivery so far in July. And in terms of silver, the July 2026 COMEX contract as of the other day had 7,425 contracts delivered. That's 37,125,000 ounces, or 1,155 metric tons of silver. Now, again, that doesn't mean it's leaving the vault, but someone wants physical delivery over paper promises. They want those numbered bars in their account. So what is 37,125 times $60? That's over $2 billion in gold. And I think it's important to note that. Couple more quick things. China acquired 48 tons of gold in May from London. It's the biggest monthly purchase in over a year, and that's 4.8 times more than the official 10 tons reported by China's central bank for May. They're lying about how much they are accumulating. Last thing I want to chat about, I know you got to run, is what's happening on July 24th, where China's biggest banks stop offering retail paper gold trading. And in other words, retail traders can no longer play the paper game. If they want gold after that, they'll have to buy physical or an ETF. But it's important to understand that it's the opposite of China turning bearish on gold. They're shutting down leverage. They're trying to find price discovery. And people have always asked me, why didn't China complain about COMEX and the LBMA manipulation? It's because why would they, if they know that price is artificially cheap? Why protest if you accumulate? So I guess I'll just simply say this. For years, they've played the long game. First, they bought the metal. Then they built the vaults like we're seeing, the exchanges, now the clearing systems and the settlement infrastructure. And only after that would you begin shifting the world paper price discovery to physical price discovery. So could it jump immediately? Sure, it could. Maybe, maybe not. But every reduction in paper leverage means the physical market has more influence over time. And last piece is, don't be surprised if this recent pullback not only was the opportunity for the biggest buyers in the world to load up on cheaper prices, physical, you see these huge deliveries, while the weakness of paper holders gets shook out. It's how the public gets shook out. But don't also be surprised if part of it was the levered paper positions in China are forced to unwind. But come Monday, the Chinese retail investor who still wants silver won't have margin accounts. They'll have a choice to buy ETF or a bar. And I have an idea which one I think they will choose.
The broader equity market is currently floating on unprecedented leverage, with total stock valuations reaching more than twice the total economic output of the U.S. economy. With the Buffett indicator standing at an extreme 237% and CAPE ratios remaining near historical highs, paper equities offer zero safety margin for everyday investors. The unwinding of the global currency carry trade will inevitably spark chaotic market conditions rather than an orderly retreat. As record margin debt triggers forced liquidations, asset prices are projected to collapse in a rapid domino effect across speculative sectors. Retail investors will continue to suffer heavy losses on overhyped assets as financial institutions unwind leverage behind closed doors. Furthermore, ongoing inflation will drive homeownership even further out of reach for younger generations, permanently altering economic demographics. Now, let's get back to the interview.
When you look at the stock market right now, it's very, very interesting. And in terms of trying to put things into perspective in terms of risk, when you take the total of all the stocks, all of them, and value them, they're worth more than twice the size of the entire U.S. economy. That is the Buffett indicator, which currently stands at 237. That means the market is priced at 237% higher than our national output. And when you talk about the Cape-Shiller ratio, it's at all-time highs as investors are paying over $40 for every $1 of normalized earnings. So there are no bargains in the stock market anymore. You're talking about optimism priced at something that is, I guess you could say, unrealistic. And that's all interesting. We talk about these metrics, but the bigger issue is what has been driving this overvaluation. And, low interest rates, we've talked about that. Leverage. The retail public is at all-time highs on margin leverage. So you have the retail public all in highest ratio ever or percentage ever in the public owning stocks, almost 50%. Highest amount of margin debt, like 1.6 trillion ever, and almost the highest amount of option exposure. So the public's all in on leverage and speculating. And this massive concentration that we see into a handful of stocks is frightening. And you start to wonder what happens when you see something in this sector break. And what caught my attention is SpaceX, where their shares tumbled on Friday. They've lost $1 trillion in market cap since the IPO, whereby they let all of the public in and reduce the requirements by which an accredited investor would be allowed to buy IPOs. Now it's $2,000 and Joe and Jane Sixpack can do it. The company's market value on Friday was 1.63 trillion. It was at 2.64 trillion on June 16th on its third day of trading. So the point is that the public, who has been allowed through this stock to get in for the first time, they bend the rules on accredited investing, is left holding the bag on $1 trillion loss like that. And that's just beginning, right? What happens if it's NVIDIA or if it's, we saw what happened with IBM a couple weeks ago. It's been insane. And to expect this to continue, I guess a lot of people would say, no, it's just a little bit of a correction, but is it? And what happens if it starts to affect some of these 10 stocks? This is why you see Warren Buffett sitting on the sidelines, because he understands this further down this path. And again, I'm not trying to wash all of this in doom and gloom. I just want people to understand that perhaps the things that we are seeing are not as rosy as we are being led to believe. And it's important to understand that the mainstream media doesn't do a good job of preparing us for what's coming. Jim Cramer told everyone to buy IBM. It was one of his favorite stocks the day before it was destroyed in value. CBS News said this is a great company to profile, Roslyn Capital, a week after they fired their entire staff and a day or two before they collapsed. So the mainstream media isn't your friend. This is from, of all places, Fortune, which is mainstream, but they came out and said 49% of adults, young adults, kids out of college, are now living at home, up 12 percentage points since 2019. And it talks about how the fallout will reshape marriage, having kids, and home buying. And the data comes from a Fed's report, and it basically says kids 18 to 29, 49% of them are living with mom and dad. 47% of adults in that same age group receive help from someone outside their household to pay expenses if they're not living at home. And basically the gist of the article is when people stay home longer, it delays the ages in which they marry. This demographic shift impacts the markets. It impacts college enrollment, retirement ages, housing markets, etc. All of these things are connected. And really, this is me chiming in and saying, too, I have a cough drop here. It says, when a country chooses inflation In other words, that was kind of the moral of what they were talking about. And I would say when a country chooses inflation to deal with its obscene piles of debt, these necessities of life, like home ownership, become way out of the reach of a growing number of citizens. This is what happens when you mess with Mother Nature and suppress interest rates. Home ownership becomes unrealistic, and we're seeing that with young kids living at home. And what does that look like down the road? My guess is it only gets worse, and we can talk about inflation. Inflation, by the lying metrics of the Bureau of Labor Statistics, it came down last month. Oh, great, because oil was down. Bunch of nonsense, right? The petroleum reserve, the U.S. Strategic Petroleum Reserve, is at 96. It's lost 96 million barrels since March. It's at its lowest level in 45 years. And what's even more concerning is that 75, as they call it, critical energy assets have been damaged or destroyed across the Gulf region.
A major structural shift is rapidly unfolding beneath the surface of global commerce as major financial institutions begin rejecting cash settlements in favor of physical commodity delivery. Massive delivery demands on the COMEX exchange highlight that institutional players are securing billions of dollars worth of physical gold and silver rather than holding paper promises. Concurrently, Eastern central banks are systematically shutting down retail paper trading options to eliminate leverage and force price discovery directly into physical markets. Once paper market manipulation is neutralized, physical supply constraints are predicted to dominate pricing mechanics, paving the way for explosive price adjustments in real assets over time. Outside of monetary metals, fundamental resource reserves are swiftly deteriorating. The U.S. Strategic Petroleum Reserve has dropped to its lowest level in 45 years, while energy infrastructure suffers widespread degradation. As governments continue choosing inflation to service unsustainable debt loads, basic necessities will become increasingly unaffordable for the average household. The inevitable unraveling of paper leverage will accelerate the global transition toward tangible assets, leaving paper-denominated wealth vulnerable to severe purchasing power destruction. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.